In this video, you'll learn the 5 stages an options trader typically goes through before they reach consistent profitability. Also, the most popular options trade structures and the pros and cons of those. Plus, a special invitation to get a $250 off voucher for my next Premier Level 5 Trading Masterclass. Quick disclaimer, some parts of the video are blurred out as it is proprietary information. Here's a quick look at the trader matrix that I'll quickly go over before I go over the pros and cons of the most popular options trade structures. So the PL5 trade structure evolution. So stage 1, if you guys recall, you probably all know this, or maybe this is a little bit of a recap, but stage 1 was like fundamental trading, right? So I would watch the NBC. This is back in the day and back in the 90s. And, there'd be this story about a stock. Apple's coming out with a new iPhone with titanium, right? That's a good reason to buy Apple stock, right? So not really. I found that wasn't a good way to buy stocks and make money, maybe in the long term, 5 or 10 years. But short term wasn't a good play. So I learned and did not do that. Then I went into picking a direction based on a chart pattern. That was stage 2, right? So candlesticks, squeeze plays, Fibonacci, moving averages, things like that. I tried to make money being directional. That didn't work out for me. It was difficult to manage my money around it. Sometimes I would have a large position and lose, and then I have a smaller position and I would win. And it wasn't like, how do you manage your money around that? Then I realized I could use options for leverage, right? And I can actually have more losers than winners, because before in the last stage, I was thinking, I'm only winning half of my trades. Maybe I can find a way to, if I don't win half my trades, if I win less than half my trades, I can still make money. And that's by buying options, right? So if I can use leverage, I don't have to win every trade. I can only win on a couple trades, maybe 3 out of 10. And I could make so much money with that leverage that it would overcome those 7 losers. But what did I find? I found that options are overpriced, because it brought me into stage 4, because I found that the implied volatility is higher than the realized volatility about 80% of the time. It was 83%, but now it's kind of dropped down to about 80% based on some studies. And you can see here, for example, the implied volatility here, the price of the option right here, for example, is higher than actually really what happened. So it's kind of that gambling mentality. People want to take risk. They want to use leverage, and they overpay for options, and options are overpriced. And so there's an edge when you sell them. But the problem with that edge is that it's an incomplete edge, because when all these stocks, for example, become correlated in a crash, they all go down together. And so that is the problem with stage 4 trading. It works great in 3 of the 4 market types, right? Until the market crashes, and then everything becomes correlated. And now everything's moving together, and you're stuck being short premium and getting hurt. I think probably a lot of you have experienced this, and that's probably why you're here. That would be my best guess. So then I came into stage 5, which is truly non-directional, because it takes advantage of second order Greeks, gamma, vama, vana, charm. This is phase 5. You need to take advantage of the second order Greeks in order to be really, truly non-directional. And I'm going to get into that here in just a minute on different trade structures. But here we can see the level 4 versus level 5. See how there's an edge. Both of them have the same edge, but it's deceivingly non-directional, right? Level 4, where level 5 is truly non-directional. The consistency is temporary, right? Until the market crashes. And the generic options trade structures are actually directional. And I'll get into that a little in a couple minutes. Because the problem with this is it doesn't have positive VAMA. When you're not hedged, your VAMA is not positive, and that's what kills you in a crash. One of the other things is, a lot of these guys, they trade multiple underlyings. It's better to manage one underlying, I've found. The rules are a little more subjective here, objective rules with the level 5. If you're trading like a tasty trade, you're always in front of the computer trading all day. This, when we're trading, it's only 15 to 30 minutes a week. You can have massive losses. And also, I like to make the point that with the system that we're trading, in that first leg down, we're going to go down with the market. And then as the market levels off, goes sideways for a minute or comes back for a minute, that's when we'll come back to making money and recover. And also, it's been proven to outperform the S&P 500 based on the numbers that I have, back test and forward tests. Basically, I'm talking about the PL5 here. Okay, so let me move this over. I'll get into this here. So what I'm going to do is go back into OptionNet. I'm going to go into an account that I created yesterday with these trade structures, and we'll go into the evolution. So the first kind of, use SPX. So the first kind of evolution thing that I thought about, right? The level 4 traders versus level 5 is that they use credit spreads, right? Credit spreads are very commonly used. I'll just kind of use more of the tasty trade philosophy, kind of go 45 days out. I'm sure a lot of you are aware of their kind of thought process and philosophy of how they trade. So maybe I'll go here -1. And let's see. So you have a credit spread, right? And what this is a high probability trade because you're selling premium. But there's a couple issues with it. And let me kind of get into that. So this is actually very directional. If you look at the T+0 line, look at how directional you are, right? So if the market moves up, you can see you make money, and if it moves down, but it's really directional. So what you're trying to do when you're selling premium, you're trying to take advantage of the edge. And the edge is the implied volatility versus the real volatility. Well, if you're too directional overcomes that edge, right? And that's what you're doing when you have credit spreads on. Typically, you have so much direction that the edge is overcome. So that's kind of the downside of a credit spread. And also, when you increase the probability of making money, so if I did this, I would be increasing the probability, right? When you increase the probability, you also increase the amount of risk. So when you want a better probability, you're increasing your risk. So it's kind of a trade-off right there too. So that's kind of like the credit spread. Next, let me bear with me here as I create an iron condor. I think typically they like to go about 16 delta. Let's see here. About 16 delta right here. -1, and let's say 50 points wide. 50. And then, it's a credit spread basically, but it's two credit spreads, the iron condor, right? It's a credit spread on both sides. So, and they typically like to do it at one standard deviation. It's kind of a common theme amongst people that do iron condor. -1, 5. So there's your iron condor, right? So technically, they say, if you stay within the one standard deviation, you're going to make, whatever this is, $1,200, and you're risking about 3 times that. So your risk reward isn't really good. But then look at the T+0 line. Look at it's really directional. You would think it wouldn't be so directional, but it's really massively directional. And really, the goal is to make your gamma line or the T+0 line flat, right? That would be the goal if you're trying to take advantage of the edge, right? The edge is implied volatility versus real volatility. Well, to take advantage of that edge, you don't want to be directional. And look at how directional this structure is. So that structure is not what I like, it's not what I use. And that's kind of the reason behind it. Now we have the calendar. Calendar's not too bad. Let's say I go here. This is like a long calendar. It's out of the money. So usually I like to do it at the money, right? Let's go up. Let's try this more closer to at the money. So the calendar is not, you're getting closer. This is not too bad. Look at the T+0. It's a lot flatter than the other structures. It's nice and pretty flat. The calendar's not bad. I mean, but the problem is, your risk, you have to pin this strike, which never happens. I mean, it could happen, but it just hardly ever happens. So you've got your profit zone here kind of small. You got your loss to either side pretty high in relation to how much money you could make. The risk reward isn't too good with this, but the T plus zero is a lot flatter. So you are this is a better structure, in my opinion, than the last two, right? But then I think an even better structure than that is a butterfly. So let me get into kind of the traditional butterfly structure here. See if I can build one real quick. So here's your butterfly. It looks very similar to the calendar, but notice I think it's better than calendar because look at the risk. You've got all this possible reward of 4,000, 2,500, and then you're only risking, $400. So I like the risk reward much better. You do have that flat T0 line. That's very nice and flat. So this is a pretty good structure. It's not really the probability, right? So here's the one standard deviation. So the probability that when this thing expires in 45 days, the probability is you're going to be outside of this tent, right? So it's just kind of a lower probability, but it's a nicer structure that I like. I think it's a better structure to trade. I would trade this over the last ones. And then kind of the next thing beyond this would be a broken wing butterfly, right? So I think the next evolution is a broken wing butterfly, which I like. So if you break that wing, you can kind of take away your upside risk. See if I can get this thing a little tighter. See, there you go. So now you've got the advantage of the flat gamma line here, but you also have eliminated your upside risk. So I like that broken wing butterfly, right? I think it's a great way to go when you look at the structure. So, it's very non-directional. It's got a relatively long runway, right? As far as the gamma line. See that? That's nice. That's a nice structure right there. And you got some headroom, right? You got some theta, like in the future, here's what's going to happen. It's going to go up. It's going to go up in terms of profit. So you've got that broken wing butterfly. Let me see here. The only thing you have to worry about is managing your downside risk, right? With this structure. The thing is, it's also got negative vega, right? So that negative vega, when you increase the vol, it doesn't like it. So you are at risk when it comes to a crash, right? But other than that, this is a nice structure that can make some money. As the market doesn't crash, you can do well with something like this broken wing butterfly. You can put some rules around it and capitalize on it. But we have now the PL5. And when you got a neutral delta, that means that your T plus zero line is flat. And you can see that this thing forms a profit hump. What I mean is, if you look at the second or third order Greek of color, you can see that what happens in 9 days from now is this red line. So what's happening is you can see the future of the profit's going to get higher, everything else being equal. So there's a profit hump. So if you stay delta neutral, you stay closer to the profit hump. You want to live at the profit hump because you want to live somewhere where your profit goes up faster as time goes by. So this is a broken wing butterfly. The PL5 is a broken wing butterfly, but it also has a hedge. So you can see here the positive VAMA, right? So it has negative vega, right? So if volatility increases, see that first leg down, that volatility increase, and you come down into it, you're going to be down. But as the market continues to rise or continues to fall, and you get into a crash scenario, you can see the vega actually increases. So that's called positive VAMA, right? So the way I explain it is it's kind of the exponential part of vega. So if I increase volatility, you can see initially you're going to be losing, but eventually as the market crashes, you can see that T plus zero rise. That's the hedges kicking in. That's the advantage, right? So you have that broken wing butterfly, which there's a lot of advantages to it, but also you want to add that extra element of proactively hedging. The basically this is non-directional, right? Because you're now taking advantage of the Greeks and the implied volatility versus real volatility. You're taking advantage of that because you're not direction is not overcoming that edge with this structure. It also works with a broken wing butterfly, but again, you're not hedged with that structure. If you found this informative, go ahead and add yourself to the PL5 VIP waiting list as an early bird and get that $250 off voucher. See the link in the description.